I spent an additional amount of 2 lakhs on the preparing and repacking of inventory. The inventory was sold on 15th May, I was at 9 lakhs. Account was Jupiter threads the event of adjusting events, adjust on the events carrying a damage of inventory financial year. Accordingly, remeasure the inventory cost 8 lakhs, net asset value 7.6, inventory's lower cost of the 7.6. Analyze whether the above accounting treatment made by the accountant is a renter regarding the financial year ending 31st of the complaints in the NDAs. If not, advise a correct statement along with the rocking of the same. Solution. The above treatment needed to be examined in the light of the provision as per NDAs 10 events after reporting period and NDAs 2 inventories. And para 3 of the NDAs, the events after the reporting period, events after the reporting period are those events favorable and unfavorable that occurs between the end of the reporting period and the date when the financial statements are approved by the board of directors in the case of company and by the corresponding approval authority in the case of the other than entity or issue. Two types of events are identified. Those provide evidence of the condition that exists at the end of the reporting period, adjusting events after the reporting period, and those which indicate the condition that arose from the reporting period, non-adjusting events from the reporting period. Further, the para 10 of the NDAs 10 stated that the entity shall not adjust the amount recognized in the financial statement to reflect the non-adjusting events after the reporting period. Further, paragraph 6 of NDAs 2 defines net realizable value is an one estimated selling value in ordinary course of business less than the estimate cost of completion and estimate cost necessary to be made for sale. In the further para 9 of the NDAs 2 states that inventory shall be measured on the lower of the cost and net realizable value. Accountant of Jupiter has remeasured the inventories after adjusting the event of the financial statement, which is not correct and not according to the provision of NDAs 2 and according to the event causing the damage of inventory occurs after the reporting date as per the principle laid on the NDAs and event after reporting date. Non-disclosure event it does not affect the condition of reporting date. Non-adjusting events are not recognized in the financial statement but are disclosed in the effective of the material. Thus, as per the provision of NDAs 2 and NDAs 10, recognized by the inventory shall be recorded in the balance sheet of the value of 8 lakhs calculated below. Cost is 8 lakh, net realizable value is 9 lakhs. Inventories, whichever is low or net realizable value 8 lakhs. On the 1st April, on 1st April, the Sun Limited has acquired 100% shares of the Earth Limited for 30 lakhs. Sun Limited has 3 cash generating unit ABC and the fair value of 12 lakhs, 8 lakhs, and 4 lakhs respectively. Company recognized a goodwill of 46 lakhs for the related to CGU and C Limited. During the financial year, the CEO of the company has viewed that there is no requirement for any impairment testing of the CGU since the recoverable amount is comparably higher than the carrying amount and believe there is no indicator of impairment. Analyzing whether the view adopted by CFO Sun Limited is complaints with the NDAs, if not advise a correct statement and according to relevant NDA solution. The above return need to be examined in the light of the provision of the NDA statistics impairment of asset. The para 9 of NDA statistics impairment of asset states that as given a state shall assess at the end of each reporting period whether they are indicates that the assets may be impaired. If such indicates exist in event shall estimate the recoverable amount of assets. Further, the para 10b of the NDA statistics states that the impairment of assets and the impairment irrespective whether there is an indicator of impairment or entity shall also test the goodwill acquired in the business combination of impairment annually. The Sun Limited has not tested the CGU on the accounts has not have any indication of the impairment in the partially correct that is respect of CGU A, B and but not CGU C. Hence, the treatment made by company is not accordance with the NDA's 36 impairment of assets. According to the impairment testing, the respect of CGU A and B is not required since there is no indication of impairment. Our Sun Limited shall test the CGU C respect of the indication shall test the CGU C irrespective of the indication of the impairment annually as a goodwill acquired on the business combination was fully allocated to CGUC. Case study 5. The Deepak starting a new company of Soft Bharati Limited and the Ikatari Limited has invested 65% are done by the Ikatari Limited, rest by Deepak. The voting powers to be given was passed for the proportionate share of the capital contribution. New company formed as the subsidiary of Ikatari Limited where 2 directors Deepak eventually becomes one of the director company. The consultancy of the hiring hired and charges 30,000 on incorporation company and 2 other necessary statutory registration 30,000 to be charged on the expenses of the books after the incorporation of the company. And the company software private incorporated first April. Financial of is prepared on the husband is an accountant who is hired at the time of company incorporation has prepared the draft financial statement of as per the end 31st March. Revenue of the operation 10 lakh, other income 11 lakhs, total revenue expenses purchase of stock 5 lakhs, decrease in stock 50,000, increase 70,000, employees benefit expenses 1 lakh 75,000, depreciation 30,000, other expenses 30,000, total expenses, profit before tax, current tax and profit and tax expenses, profit of the year, balance sheet. So, equity and liability, shareholder fund, share capital, reserve and surplus 230,000, non-current liability, current liability 25,000, default tax liability 6,000, current liability payable 11,000, other current liability 45,000, short-term provision 1,06,500, total assets, non-current asset, plant property equipment 1 lakh, long-term loans and advances 40,000, other non-current assets 50,000, current asset investment 30,000, inventory 50,000, trade receivable 55,000, cash and cash equivalent 1,50,000, other current asset 41,000. Additional information software limited, deferred tax liability 6,000 is created on the following temporary difference: depreciation amount as per the income tax and amount and accounting profit. There is only one property plant equipment in the company where the closing balance of the reverse asset discussion plant property as per the books 1 lakh, as per the income tax 80,000. Pre-incorporation expenses are deductible on a straight line basis over the period of income tax. However, the same is immediately expensed off the books and the current tax higher 30% on PGB 35 without doing any adjustment relating to income tax. The current tax after doing necessary adjustment allowances and disallowance relating to income tax comes to 1,25,500. After the reporting period, directors recommended a dividend of 15,000 for the year ended 31st March and being deducted from the reserves and surplus, and dividend payable 15,000 has been grouped under the other current liability alongside financial liability. There is a government statutory dues amount of 15,000 and grouped under the other current liability. The capital advances are amounting to 50,000 grouped under other current assets. Other current other current asset of 51,000 comprises in interest receivable and trade receivable, and current investment of 30,000 is the share of the company which is done for the purpose of trading. Current investments carried out in the cost of financial statement. The fair value of current investment is 50,000 on 31st March. The auxiliary gain of employee benefit in measure of 1,000 has been omitted on the financial software private limited in 31st March. Financial statement financial year 31 period has not been yet approved. You are required to ascertain whether the financial statement of banks are considered present as per the applicable financial reporting framework. If not, prepare the financial statement of the bank after the carefully analyzing the mentioned fact of information. If the NDA is applicable to the company, the NDA shall automatically be made applicable to all subsidiaries, holding company, associate company, joint venture of the company, and irrespective of the individual qualified to set standard of the company. In the given case has been mentioned, the financial statement of Vikadari Limited prepared as per the NDAs according to the result of subsidiary Softbury Private Limited and should also have been prepared as per the NDAs. Therefore, the state financials of Softbury Bank has been presented as per financial NDAs. Hence, necessary to revise the financial statement of Softbury Limited as per the NDAs after the incorporation of necessary adjustment mentioned in the question. The revision of financial statements of Softbury as per NDAs and Division 2, Schedule 3 of Companies Act as follows. Statement of profit and loss account: revenue from operation 10 lakh, other incomes 1 lakh plus 20,000 into other expenses 11 lakh, total revenue 11 lakh 20,000, expenses purchase of stock and trade 5 lakhs, increase and decrease of 50,000, employee benefit expense 1 lakh 70,000, depreciation 30,000, other expenses 90,000, total expense 7 lakh 40,000, profit after tax 3 lakh 75,000, current tax 1 lakh 50,000, before tax 4,800, total tax expenses 1 lakh 30,500, profit after the profit for the year 2,44,900. Other comprehensive income items that will not be classified in profit and loss account: remeasurement of net defined and benefit 1,000, tax liability related to the items that will not be classified to the profit and loss account, reimbursement of net deferred benefit plans 1,000 into 30 percentage. Other comprehensive income 700, total comprehensive income for the period 2,48,500 minus 400 plus 700 1,45,200. Balance sheet of 31st March asset on current asset plant and property 1 lakh, financial asset financial asset, other financial asset, long-term loans and invested equity, other non-current asset, capital advances, 50,000, current asset, inventory, 80,000, financial asset, investment, 30 plus 20,000, 50,000, trade receivable, 50,000, cash and cash equivalent, 1,15,000, other financial asset, interest receivable from trade receivable, 51,000, total asset, 5,41,000, equity and liability, equity share capital, 1 lakh, other equity, 2,40,200, non-current liability, provision, 25,000 minus 1,000, 24,000, deferred tax liability, 28,000, 4,800 plus 300, 5,100, current liability, financial liability, trade payable, 1,000, other financial liability, 15,000, other current liability, commercial liability, 15,000, other current liability, 1,20,700, total equity and liability. Statement for change in equity for the financial year, equity changes as per 31st March, 0 change in equity of capital, 1 lakh, so as of 31st March 21, 1 lakh. Other equity, as per the March reserve and surplus 0, profit of the year 2,45,700, other comprehensive income of the year 700, total comprehensive income of the year 2,45,200, less dividend of the equity share 0, as of 31st March 2,45,200. Disclosure formatting part of financial statement, proposed dividend as the equity share is subject to the approval of shareholder of the company, the annual general meeting, and not recognized as a liability of the balance sheet. On 31st March, notes on the current investment has been held over the proposed trading against the financial assets classified to PVTPL. Any gain in the fair value of recognized to profit and loss on 20,000. Hence, an increase the fair value of financial asset will be recognized as profit and loss on. However, it will attract deferred tax liability in the increase in value. Assets for which the future economic benefit received of goods and service rather than the right to receive cash and other financial assets is not a financial asset. Liability for which there is no contractual obligation to deliver cash or other financial asset, other entity is not a financial liability as per the India's 10 events after the reporting period. If dividend is declared after the reporting period but before the financial statements are approved for the issue, the dividends are not recognized as a liability at the end of the reporting period because no obligation exists at the time. Since the dividend is disclosed in the notes and according to the India's one presentation of financial statement, other current financial statement balances of other current liabilities as per the 45,000 less dividend 15,000, reclassification and government started reduce payable 15,000, so closing balance is 15,000. Working on calculation of deferred tax on temporary difference as per the India's to allow the financial item carrying amount tax basis difference and DLA. Plant property equipment carrying amount 1 lakh, tax basis on the 80,000, the difference is 20,000, so DLA 30% and 20% 60,000. Pre-incorporation on nil, so tax base 20,000, 20% difference, 30% 700. Current invest 50,000, tax base 30,000, so difference 20,000, DTA 30% of 60,000, so totally 6,000, 6,000, 5,000, 6,000. Net DLA is property current investment 6,000. Net DLA 4,800 DLA. So pre-incorporation expenses, asset, plant and property, DLA expense, so 6 plus 1,000 minus 1,100, so 4,800. The Mumbai Challengers Limited is a listed entity. It is a sports organization owned several cricket and hockey teams. This issued a borrow pertaining to the reporting period 31st March. Owing to the proposed schedule of Indian Hockey League is the Indian Premier Tournament, Mumbai Challengers need a new stadium to host the sporting event. The stadium will be the part of the property, plant and equipment of the company. Mumbai Challengers Limited began the construction of the stadium 1st October of 1, and then the construction of the stadium was completed in the cost directly related to the construction amount 140 crores, and therefore 350 crores have been incurred per month. 350 crores cost incurred by the construction amount 140 crores. After 350 crores have been incurred per month until the end of the financial year. The company has not taken any specific borrowing in the finance of construction of the stadium. Although it's incurred finance cost on a regular overdraft during the period, which is avoidable. Hence, the stadium is not constructed. Mumbai Challengers Limited has calculated this weighted average cost of the borrowing on 1st October December to 31st March, amount of 15% per annum annualized basis. Company seek advice to treatment of borrowing cost in financial statement as of 31st March. Mumbai Challengers Limited acquires sell players registered on the regular basis. For a player to play for the team, Mumbai Challengers must purchase registration for the players. This player registered on the contractual obligation between the player and the company. The cost of acquiring player registers including transfer fee, league level fee, and the player agent of fees incurred the club. At the end of this class, this happens also report during the period of Mumbai challenges to our club review contractors with the players and making decision as whether they wish to sell, transfer any player registration. This company actively market the registration of circular with other clubs of a list of members. Registration and estimate the selling price. The player's register is also sold during the season after, often with the performance condition attached. In some cases, it has become clear that the player will play the club again because it, for example, player sustained the career-threatening injury being permanently removed for playing the squad of each other. The player registered certain players and sold after the year end. And total proceeding net accessory costs of 175 crores. Register has a net book value of 49 crores. Mumbai challenges him to seek advice of treatment of acquire extension review and the sale of players. Registration of circumstances outlined. The Mumbai challenges limited measure stadium according to the Mumbai challenges limited measures the stadium according with the valuation model. The airline companies approached directors of 700 crores of the property naming rights of the stadium for 5 years. The three directors are in the management of both Mumbai challenges and the airline. Additionally, statutory registration regulator financial both the cricket and hockey clubs. This regulation prevents a contribution to the capital from related parties and increases equity without repayment. The failure to adhere these registration would tends to impose of fines and withholding of prize money. Mumbai challenges want to know how to take account of the name rights in the valuation of stadium and the potential implication of financial regulation imposed by the registration. Solution borrowing costs. As per the NDA 23 borrowing costs, the entity shall capitalize the borrowing costs. They are direct attributed to acquisition, construction, or production of a qualifying asset. That is, asset is necessary take substantial period of time to get ready for the intended use of sale. As part of the cost and the asset, the borrowing cost that is directly attributable to the acquisition, construction, and production of qualifying assets, or the borrowing cost that would have been avoided if the expenditure and the qualifying asset has not been made. To the extent that as an entity borrows funds generally uses them for purpose of obtaining qualifying asset, entity shall determine the amount of borrowing cost and eligible for capitalizing and by applying capitalization rate of expenditure on the asset, and capitalization rate shall be weighted average of borrowing costs applicable to the borrowing of the entity that is outstanding during the period. The capitalization rate of borrowing is Mumbai challenges during the period of construction. 15% is per annum. Therefore, the total amount of borrowing cost to be capitalized and the expenditure incurred on the total asset multiplied by the capital rate and which is under. The cost incurred December 140 crores, 15% on 4 by 12, and cost incurred March 350 crores, 15% on 3 by 12. Uh, February 12 and December, yeah, January, February, March, February 2 by 12, 350 crores, 15%, cost income 3050 crores of 1%. So borrowing cost is capitalized 33.250 crores to 2.5 to 2.250. The weighted average carrying amount is 140 to 350, 350, 140. 140 into 5 is 634 crores. Applying the weighted average cost of borrowing 15% in the total borrowing cost is 655 crores into 15% into 4 33.25 crores. Correct. Player registration acquisition. As per the NDAs 138 intangible assets, an entity should recognize intangible asset whether it is probable that expected future economic benefits that is attributable to the asset will flow of entity and the cost of asset are measured reliably. According to the cost associated with the association of the players, the registration would need to be capitalized, which need to be amount of cash or cash equivalent are paid on the fair value of other consideration given to acquire the registration. In line and NDAs 38 intangible assets, cost would incur transfer fees, league fees, player player in the line of NDAs 38 intangible asset cost which incur transfer fees and league fees and player agent fees incurred in the club according to the general attributable cost. If any amount capitalized would be fully amortized over the period covered by the player's contract. Sale registration. Player registration must be classified as asset for the purchase sale under NDA is 105 the non-current asset held by a sale of this continuing operation when this carrying amount is expected to be recovered principally through a sale transaction. The sale is considered to be highly probable. To consider a sale of highly probable, the asset in this case player of registration would be actively marketed for sale at price that is reasonable to relation to the current fair value. In the given case, it was appear that the management is committed to plan to sell the registration, that the this asset is available for the immediate sale, that is active plan to locate buyers in ready to play the circulating clubs. NDA's 105 stimulates that it would be likely that the plan to sell registration would be significantly changed to withdrawn. To fulfill the requirement, this would be prudent if any of those registrations are classified and held for sale with unconditional offers of this received prior to the reporting date. These registrations classified the sale whether unconditional offers has been received as received prior to the reporting date. Once the condition of classifying the assets are held for sale is recognized, in case 105 has valued the play the considered registration would be stated at lower to carrying amount and the fair value less cost to sell, with the carrying amount stated according to the NDAs 38 prior to the applicable NDAs of 105 subject to the impairment if any. Profit or less of the sale, profit or loss on sale of player registered would be computed and deducted the carrying amount of the player registration from the fair value of consideration receivable, net of the transaction cost. And in the case of portion of the consideration is receivable on the occurrence of future performance condition, that is contingent consideration. The amount would be recognized on the statement of profit and loss of only when the conditions are met. The player registration disposed of the subsequent the year and 135 crores having corresponding book value of 49 crores would be disclosed as non-adjusted event according to say in events after reporting period. Impairment of review and is 136 impairment asset required the company annually test the assets for impairment. Asset is said to be impaired if the current value of the asset exceeds the recoverable value. The recoverable amount is higher than the asset fair value less cost and sell the value in use. In this present value of the future cash flows are subject to the arising of the use of asset. In the given scenario, if it is not easy to determine the value of use of player's isolation, the player cannot generate cash flow or his or his own unless it is a sale transaction or insurance recovery. While as any individual player cannot rely on be separately from the single cash generating unit (GCU). Being a cricket team or a hockey team, in the instant case, there may be a certain instances where the player is taken out for the GSU, and when the becomes clear that he or she will not play the club again, if she recommends that the the carrying amount of player should be assessed against the best estimate player fair value less the cost to sell, the impairment charges would be recognized in profit and loss and it reflects any arising losses. Valuation stadium. In the terms of the NDS 113 fair value measurement, stadium would be valued at the price which would be received in the sale to sell the asset in ordinary transaction between the market participation at the measurement date. This would be the one of the maximize the value of the asset and group of assets using the principle of highest of best use. The price would essentially use level 2 input, that is input other than the quoted market price including level 1, which is observed the assets and liability either directly or indirectly properly named the rights present completion where the value of properties. The state of property indicates India is suitable for inviting sponsorship activities in the name. It has nothing to do with the property itself, but in the can be significant amount. Therefore, the Mumbai challenges as individual property name rights and valuation of stadium the right of the 3 years. NDA 24 related party disclosure lists the criteria of two entities treated as a related party. Such criteria includes being members of the same group where the person or close members of the person families related to the reporting entity if the person has control or joint control over the reporting entity. In NDA 24 deemed that person are not related simply because they have a director or a key members of the common. In this case, there are three directors in common and the absence of any information in the contrary it appears as through the entities are not related. However, the regulator will need to establish whether the sponsorship deal is a related party transaction for the purpose of the financial control provision. This would need to demonstrate that the airline may be expected to influence or be influenced by the club or related party of the club. If the deal is deemed to be a related party transaction, regulatory will evaluate whether the sponsorship is a fair value or not. Case study 7 Neil Lanchal Gas Refinery Limited. NHS body is involved in production of trade of natural gas oil. The Lanchal jointly owns underground storage facility to another entities. Seamanchal Refinery Limited, whereas therefore Seamanchal, both the companies engage in extraction of gas from the offshore gas fields, which they own and operate independently at each year. The Neelach owns 60% of the underground facility, as Seamanchal owns 40%. Both the companies agree to share the service and cost accordingly. The decision relating to the storage facility required anonymous agreement of the parties. Underground facility is pressured pressurized so that the gas is pushed out when extracted. Then the gas pressure is reduced at a certain level. The remaining gas is irrecoverable and remains in the underground storage facility. It is decomposition as a result of the law of force. The storage facility would be decomposed at the end of the useful life. And Neil and Chell seeks your advice to treatment of the agreement of Seaman Chell as well as accounting of this irrecoverable gas. Neelachal has entered into a 10-year contract with Uttarakhand Refinery Limited, wherein the defined Uttarakhand this purchase of natural gas. And the researcher has paid the advance of Uttarakhand equivalent to the total quantity of gas contracted for 10 years based on the forecast price of gas. Advanced amount carrying interest of rate of 12.5% per annum, which is settled by the Uttarakhand by way of supply of extra gas. The contract requires liquid fixed quantity of gas to be supplied each month. In addition to that is a price adjustable mechanism. The contract thereby the difference between the forecast price of gas and privilege market price settle the cash and queries. Basis. This Uttarakhand has not delivered the gas as agreed and has a right to claim compensation computed on the current market price of the gas. Neelanchal wants to account for the contract of Uttarakhand in accordance with the India's 109 in financial instrument to seek any input of the records. Joint agreement. As per India's 111 joint agreement. Joint agreement is agreement in which two or more parties has joint control. Joint control is contract agreement sharing control of the arrangement. Both exist only when the decisions about the relevant activities are required for unanimous consent of the parties sharing control. The structure is form of the arrangement determines the nature of ownership. However, the respective of the purpose structure is form of agreement. The classification of joint arrangement depend upon the parties' rights and obligation arising on the agreement. Accordingly, the joint agreement could be classified as a joint operation or a joint venture. Joint agreement, which is not a structure through separate vehicles of joint operation. In this case, a contractual arrangement establishes a party rights and obligation. Joint operator accounts of assets and liabilities, revenues and expenses relating to the involvement of joint operation in accordance with the relevant NDAs based upon the information provided. The arrangement of Seamantal Refineries Limited is a joint operation and no separate vehicle is formed. The company has agreed to share services and costs to decision regarding the storage facility required anonymous agreement. Parties and Neil and gas refineries should recognize the share of the assets and property, plant and equipment. As per the para 16 of NDA 16, plant and equipment, the cost of the item of the property, plant and equipment comprised of initial estimated cost of demanding, removing items and restoring a site in which located. NDA citizen provision, contingency liability and contingent asset providing guidance for measuring decomposition restoration of similar liabilities. Para 45 India 37 provides that if in effect of the time value of money is material, the amount is provision shall be present value of expenditures expected to be required to settle the obligation. As the cost incurred by the entities respect of obligation is dismantled, removing the restoring a site in which items, property, plant, equipment situated, and recognizing the measurement of accordance with India 16, India 17, which is journal entry, plant, property, and equipment. Provision for dismantling, removal, and property amount. An Iran gas refinery should recognize 60% the cost of decomposition of the underground storage facility. However, in para 39-79, the entity is jointly and severally liable for the obligation. According to the Neelam gas refineries, it will be also 40% of the cost of decomposing of the underground facilities contingent liability should be the arising from the events of preventing seamen refineries from fulfilling the obligation under the agreement. As per the NDA 17, land, property, and equipment, tangible items that was held the use of production or supply of goods and service for rental or others of admission purpose and expected to use during the period for one period. A Neil and gas refinery should classify the account of shares and irrecoverable gas on the property, plant and equipment in the irrecoverable gas is necessary for the storage facility to perform function. Therefore, irrecoverable gas being the part of the storage facility should be capitalized as a component of storage facility. and should be depreciated in the residual value over the life of storage facility. However, the gas is recoverable in full upon decomposition of the storage facility. Then depreciation against the irrecoverable gas component will be recorded only if the estimated residual value of the gas decreased below the cost during the life of the facility. Upon the decomposition of the storage facility, when the caution of gas is extracted and the sold, the sale of irrecoverable gas is accounted and disposed of the item of plant, property, equipment according to India 16, resulting gain and loss are recognized in profit and loss account. The natural gases extra excess of the recoverable gases which is injected into the facility would be treated as an inventory according to the NDA's two inventories. A contract with the Muttar reference implemented. As per the para 2 109 financial instrument, the storage standard applies to where the contract to buy, sell non-preferred items that can be settled net gas and another financial instrument or exchange financial instrument. As if the contract of financial instrument with the expected to of contracts that were entered into and continue to held for the purpose of receipt of delivery of non-financial items in accordance with the entity's expected purchase, sale and usage of the requirement. That is use of contract. The contract with the result of physical delivery of the commodity extra gas. As a respect of the India's 109 provides that the contract to buy and sell non-financial items that can be settled net cash or another financial instrument or exchange of financial instrument, or if the contract as a financial instrument may be irrevocable, distinguished as a measure of fair value through the profit and loss, even if they entered into the purpose of receipt of delivery of non-financial items accordance with the entity's expected purchase, sale, and usable requirement. The designation is available only in the receipt of the contract, only on estimated and significant reduction and recognized consistently. Sometimes refer to the accounting mismatch. They would be otherwise arising in not recognizing the contract between excluding the scope of standard. That is in various ways which a contract to buy, sell non-financial items can be settled and net in cash or accordance to another financial instrument or exchanging financial instrument is included. In the terms of contract permitted either party to settle the net cash on another financial instrument or by exchanging financial instrument, then the ability to settle the net cash in another financial instrument by exchanging financial instrument are explicit of terms of contract by the entity has practicing settler similar contracts on net cash of another financial instrument by exchanging financial instrument, whether the contractor entering into the offset contract by selling and contracting between the excise labs. When this similar contract, the entity has a practice taking delivery of the underlying and selling it within a short period after delivery of the purpose of generating profit from a short-term fluctuation of pricing on dealer's margin, and when the non-financial item that is subject to contract is readily convertible cash. The return opinion to buy and sell non-financial items such as commodity that can be settled net in cash or another financial instrument and by exchanging a financial instrument and within the scope of NDAs or such contract is accordance as a derivative. Such a contract cannot be entered into for the purpose of receipt or delivery or a non-financial items in accordance with the entity's expected purchase, sale or usage of requirement. Judgment should be required in the area of non-net settlements caused by the unique events beyond the management control may not necessarily prevent the entities from applying its own use exemption in all similar controls. In the given case, a contract of interpretation of entire is result in physical delivery of extra cash, which commodity as not cash, a financial instrument for the use of an Neelanchal Gas Refineries Limited. Against that, it appears that the contract would be used ex contractly falling outside the scope of India's 109. Therefore, it would be treated as an executory contract. However, the argument should be placed in the contract and settled due to the penalty mechanism using in Uttarakhand refineries to compensate natural gas refineries at the current prevailing market price. Further, the natural gas is readily convertible to cash. The location of delivery, the contract would be considered as net settled. In addition, if there is a volume fluctuation, the contract would be regarded return option which falls in scope of NDS 109. However, the contract will be probably continue to be regarded as a one use or long term asset entered into the continues to rate the expected counterpart sales unless required. The addition to the entity has no irrevocable designation of contract and measure at the fair value to profit and loss and emphasis on its own destination.